Hey everyone, I'm Bradford with the Penny Pincher's Guide. Our channel's goal is to help spread financial literacy, and one topic that is confusing to just about everyone, unless you're a CPA, is taxes. Come April 15th every year, everyone is struggling trying to figure out how to make sure they get their taxes filed correctly to avoid an audit. Especially when you're first starting out, this can be something that's really overwhelming and kind of hard to get your mind around. If you're like me and you felt like you left school with a better understanding of how the mitochondria is the powerhouse of a cell instead of how your income is affected by taxes. By the end of this video today, you're going to understand how your income is impacted by taxes, how much you end up paying to Uncle Sam at the end of the year, and what take-home pay really means. To start out, I'm only going to be talking about taxes that have a direct impact on your income, as opposed to the indirect taxes like an excise tax or a sales tax, which businesses pass on to you by increasing their prices. Now, if learning more about personal finances and working your way to your first or your next million is something that sounds appealing to you, please like and subscribe. That way you'll be in the know every time we come out with a new video so we can help you make progress in your financial journey. To start off, let's look at a sample pay stub. So you can see on the left-hand side, you have where the income is listed out, and then in the middle column, you have deductions. You're gonna see three different types of deductions there, and it's gonna be broken down with the first one being federal taxes. This represents the federal income taxes that you pay. Then you have FICA, Social Security tax, and FICA, Medicare tax. Now, depending on where you live, there'll likely be another deduction for the state income tax, but that's going to follow the same principles of the federal income tax. Let's start out with the federal income tax. This is where you're going to be paying the largest percentage of your income in taxes. Unfortunately for most people, this is also the most misunderstood because we have a marginal progressive tax system. But taking a step back, where does the federal income tax stem from? It came about with the 16th Amendment in the beginning of the 20th century, when this amendment to the Constitution of the United States actually allowed Congress to pass an income tax. Prior to that point, an income tax was unconstitutional and had only occurred at one other point during the Civil War when the Union levied an income tax on its citizens. Now, as I previously stated, at its core, the federal income tax is a progressive tax system. Breaking it down to its simplest form, what that means is that under a progressive tax system, the more money you make, the more you're going to pay in taxes. Now, under a pure progressive tax system, where you just pay a flat rate depending on what income category you fall in, it is pretty straightforward. However, the US income tax works underneath a marginal tax rate, and this is where a lot of people get confused because honestly, it's pretty confusing, even when you look at the actual IRS documents. So to get a better understanding of how it is, let's actually look at the IRS tax tables for 2020 so that way we can see how these tables break down and how the marginal income tax is going to affect you and your income. Looking at the top and the bottom of the chart, it shows the lowest and the highest tax brackets at 10% and 37% respectively. Now, to understand how a marginal tax rate works, let's say you make $100,000 a year before taxes for easy math. Going down the chart, you would see that $100,000 would place you in the 24% tax bracket, but you're not paying $24,000 in taxes, which is what a pure 24% of your 100K a year would be. To determine the amount of taxes actually due, and this is aside from any sort of deductions that you would have based on donations or just the standard tax credit, you would move down the chart. You're going to add up the taxes due for each bracket until you get to $100,000. Looking at the first layer, on the first amount up to almost $10,000, you're going to pay 10% in taxes. Adding that up is $987.50. Then on the next bracket, so above that $10,000 that you've earned, you're going to pay 12%. And that's going to be from $9,875 up to $40,125. Moving on, you're going to continue down the chart. You're going to multiply the tax rate by the amount of money in each bracket. Fortunately, the max amount of taxes owed in each bracket is listed. So with a $100,000 income, that's going to fall in the 24% bracket. You go down to the fourth row and see that you owe $14,605.50 for the previous brackets. You would then subtract $85,525 from your total income to see that you will be taxed 24% of the leftover $14,475. This results in $3,474 in taxes due. You add up the amount from the previous tax brackets with the tax bracket of the 24%, meaning your total tax bill would result in $18,079.50. As you can see from walking through the actual IRS tax table, even as I explained it, it can be pretty difficult to understand. So if you need to go back and rewatch that section a couple times, please feel free to do so, because it took me a while of reading through the charts and actually looking at different resources to truly understand how a marginal tax rate works. Now, fortunately for the other two taxes that are on the sample pay stub, they're actually pretty easy to understand because they operate underneath a flat tax rate policy. And those two taxes, as I previously mentioned, are the FICA Social Security and the FICA Medicare Tax. Now, FICA stands for the Federal Income Contribution Act tax. Collectively, both the Social Security and the Medicare taxes are known as the payroll tax. Now, if you're interested in learning more about the actual background with Social Security and how FICA taxes came to be, I covered it pretty well in my previous video on Social Security and why it's not something that you should rely on for retirement. And you can get to it from the card that I'm dropping right here. Now, something that's important to know about the Social Security FICA tax and the Medicare FICA tax is that you, as an employee, you pay half of the tax and your employer pays the other half of the tax. So looking at the Social Security tax, you're gonna pay 6.2% of your income up to a max of $137,500. And your employer is also going to pay 6.2% of your income up to the same income cap. Now for the Social Security, while you're not gonna be taxed anymore once you're above that tax bracket, for Medicare, you're gonna pay 1.45% with no income cap, and you actually get taxed an additional 0.9% for any income you make above $200,000. So for both of the payroll taxes, even though you're not paying the total amount because your employer is matching what you pay, it comes out to be 12.4% for the Social Security tax, and then for the Medicare tax, it is 2.9% plus that potential extra almost 1% depending on how much money you make. Now, hopefully that gives you a better understanding of how the income tax works, the FICA Social Security tax works, and how the FICA Medicare tax works. And now you should have a better understanding of why your take-home pay is so much smaller than what you're actually getting paid. Now, I want to thank you as always for joining us today. If you got any value out of the video today, please like it and share it with somebody else to help us spread our mission of spreading financial literacy to as many people as possible. Thank you as always for joining me today, and until next time, just remember to pinch a little.